Check, please.
Welcome back to Everything Money. In this video, we're talking about one of our favorite stocks, one of the biggest value plays we've had over the past year, Alibaba. We were very much against this valuation when this stock was a $300 stock. When it got into our wheelhouse, we started loving it. And of course, it's dropped since there. Paul, the sentiments about China, the regulations have kind of faded. We'll talk about it in this video. We'll go over the financials behind Alibaba. We'll show you how to trade this at a quicker pace with Mo. All this and more. Stay tuned. I trust Paul and Mo. They own and operate over $100 million in real estate, multiple businesses and stocks, and they'll provide you and I with a mindset about investing in a company that's been tanking of late, but we still love it. Paul, tell me about Alibaba.
All right, guys. So first off, before we go any further, please follow us on Instagram, Everything Money Investing, and follow our personal accounts because I just do it. Don't be lazy. All right. So this is our Everything Money software 8 pillars tool. We're going to go to Baba.
You usually insert a joke there. You were kind of lazy, Paul.
I was being lazy myself. Just don't be like me. Just go do it.
Go ahead, Alibaba.
So full disclosure, Alibaba is my biggest holding. We have somebody in the room right now who went YOLO on Alibaba.
Recently.
Darnell. So anyways, Alibaba. Let's do a 8-pillar analysis first. First pillar, we want the 5-year PE under 22.5. It is 20.5, so that's a check mark there. Pillar number 2, we want the 5-year return on invested capital greater than 9%. It is 10%. Check mark there. And all this wonderful data is right here on our main page. There's no dividend at all, but look at this free cash flow, 5-year average of 18.7, last year 31 billion. So this company is printing money. Pillar number 3, we want to see income growth over the last 5 years. So we go to our income statement, our revenue growth, 5 years ago, it did 31 billion. Last year, it did 128 billion. Is that good? That's 4 times growth.
Pretty good.
Pillar number 4, we want to see net income growth over the last 5 years. So we scroll down a little bit. 5 years ago, it did 9.59 billion. Last year, it did 19.65. Another chickadee check right there. Pillar number 5, we want to see shares outstanding staying the same or decreasing. Guys, if a company has 10 shares outstanding and you own 1, you own 10% of the business. If they buy back 2 shares, you still own your 1 share, but now there's only 8 shares outstanding. You now own 1 out of 8 shares, which is 12.5% of the business. So just by being patient and waiting, they've made you a larger owner of the business. So we scroll down to the bottom of the income statement on our software. We look at the end of year 6, 2.48 billion in shares, and last year 2.7. Currently 2.7 billion. So that's an X. So the shares have been going up a little bit over the last 5 years. I'm not as concerned about that. It's not a huge jump, but I think there's other attributes of the company that make it far more attractive. Okay, now pillar number 6 has to do with debt. And debt operates with the company the same way it operates with you individually. When there are tough times, debt can hurt you very badly. So we want companies that have very manageable levels of debt. So what do? We go back to our main page of our software. We look at the 5-year average free cash flow, 18.7 billion. We multiply it by 5. That is $93.5 billion. We want their total long-term liabilities, their total long-term debt under $93.5 billion. Very simple. So we go to the balance sheet in our software. We scroll all the way to the bottom. Long-term liabilities, $37.8 billion. They can pay off their long-term liabilities with just doing 2 years of their last 5 years of free cash flow.
Amazing.
Yeah, so I'm not worried about this company from a debt perspective. Right. Our final 2 pillars have to do with free cash flow. And guys, free cash flow is cash from operations, less your capital expenditures. And you can do 5 things with free cash flow. You can buy back shares, pay dividends, pay down debt, make acquisitions, and reinvest back in yourself.
Boom.
And we make it easy for you. We added this line right here for the free cash flow statement as part of our software that we don't have to do the math yourself. Now with Chinese companies, the way they do reporting is we have to do it on an annual basis. So 5 years ago, they did 10.3 billion in free cash flow. Last year, 29.7. That's a check mark there. And our final metric, we want to take the 5-year average free cash flow and multiply it by 20. That'll give us a starting market cap of where we want to be with the company. It's not a saying you have to buy or you don't buy based on it, but we just start right here. 18.48 times 20 is $370 billion. We want the market cap under $370 billion. Uncle Seth?
It's 342.
It's 342. So that's a check mark there. The company is currently selling for less than our desired market cap. But remember, guys, that's not set in stone. If a company is going to grow 100% a year versus another company growing 0, you should pay a higher premium for the 100% growth a year, right? So what we're going to do now is...
Well, what we like, Paul, is a proven track record of growth, not a construed what they could do. And so this is the point, folks. You know, we've been blasted about Baba, Paul. We like this around 200, 180. We were buying at 150. And a lot of growth stocks have been coming back down to earth, and which we're very keen to point out, Paul. But the difference is this company was growing leaps and bounds. It's not what they're gonna do, not what they're gonna make in 10 years. It's what they're making literally right now. And the sentiment is low. That's when we buy.
Yeah, but it's also about what it's gonna do in 10 years. But the point is, we don't know what's gonna happen in 10 years. I like a track record so I can say, how did this company do in the last 5 or 7, 8, 10 years? Do they have a proven track record that they consistently grow revenue, grow profit, operate the business the way I want them to do, which is low debt levels? That's the point. The future is unknown for every company out there, but it's just like a baseball. It's just like any athlete. If an athlete comes off of one good season, are you going to give them a max contract versus the athletes come off of the last 5 seasons getting better every single year? Which one would you rather give? With the both have the same stats, which one are you going to give the contract to?
And of course, Paul, the biggest busts in history in sports is when they do have one good year, they overpay them and they never produce.
Correct.
Or
they have a good year with a bad team, like the Larry Hughes syndrome.
They're still paying Bobby Bonilla $1 million a year. Remember that?
Yeah, I do remember that. But he wasn't a bad player.
Oh, I know. I'm just saying it's funny.
Well, that was a terrible analogy then.
Thank you for pointing that out. I love the show's flowing
guys,
right now.
Let's use the most awesome part of our software, the stock analyzer tool. It's been so popular amongst our users. We make our assumptions. It tells us what to pay for the stock today. That's a high. That's
okay. Keep going, Paul. Sorry.
So, guys, let's do a 10-year analysis. Now, I'm going to be very conservative. I actually don't believe this low end number. I think it's
Overly
gonna be
conservative?
Way better. On the low end, I will, because I just want to show you how good of a deal Bob is. Let's say they only grow 10% a year for the next 10 years. Let's do in between at 14 and high side 18. Profit margin. I'm going to do 15, 18, and 21%. Actually, you know what? No, I'm going to do 16, 19, and 22%. Free cash flow margin, same thing. PE, 14, 16, and 18, 14, 16, 18 for the free cash flow. And again, 12.5% return on my money, because if I invest in an ETF, I'm going to get 10% return. So in order to get a proper margin of safety and a reason to buy an individual stock, let me get more return. Hit the analyze button. Guys, no brainer. That's my point here. On the low end, I have 150, high end, $437. So what this says, guys, if you believe Baba can grow its revenue 18% a year for the next 10 years and have these margins and multiple, you are okay buying the stock at $436 a share. It's currently at 127. Even on my low returns, my low assumptions, I'm willing to pay 151 for it. I don't think it's worth 151. I think it's worth more than that, but I'm willing to pay 151 to get a 12.5% return on my money. This is why I'm a believer in Baba. This is why the stock analyzer tool is such a useful tool, because we can all sit there all day long and say, oh, it's growing like crazy, but we can overpay for growth. We are underpaying for growth here, in my opinion.
And Charlie Munger's opinion.
Charlie Munger has doubled his position in the last 2 quarters each time. But again, I don't follow Charlie. I don't know what Charlie Munger values Alibaba at. What I do follow Charlie Munger on is he trusts Alibaba's numbers. That's what I trusted. Because at first, if you look at our past videos, I just said, I don't know if I trust the numbers out of China. But when Charlie Munger makes a big position there, okay, if Charlie Munger trusts, I trust.
If you can trust us with this software, if you like these numbers, you can have it right now in the palm of your hand on your phone. You can get the software right now, Paul. Tell them how.
So guys, we created a software because our users were sitting there saying, how do we analyze stocks without waiting for you to make a video? There are 10,000 stocks out there. They wanted to analyze them themselves. So we made our software. We spent hundreds of thousands of dollars. You get all of this. You get everything you've seen so far, the 8 pillars tool, retirement calculator, stock analyzer, 8-pillar portfolio, exclusive video content. Every single day we post 1 to 3 videos made by us only for our users. You get all of this. You get everything on the phone app, like Seth said. But most importantly, if you feel alone, you get the community of over 6,000 people who use the software every single day to talk about your investment ideas. Because you might be the only one of your friends who believes these thoughts. You can't talk to them. You go into the chat right here in the top right corner or on your mobile phone and talk every day about every investment idea you have. This is all for only $1 per day. Whatever price you pay, you are locked in forever. $1 per day gets you everything here. 30 years of financial data. This is a no-brainer, guys. Our competitors are $199 to $500 a month. $1 per day gets you this software. Go sign up now. 2 ways to sign up. Everythingmoney.com. or Patreon. The benefits of everythingmoney.com is you don't pay sales tax yet because we're not big enough. Sign up $1 per day.
And if you're looking to trade Alibaba, you can join Mo in the Bidnass Nation. He'll show you how to trade this. Mo, is there enough? What's going on with Alibaba? I never know.
So for the past, I don't know, couple months, I've been pretty hesitant to say people to get into these Chinese stocks. And the only reason is because we've been seeing all of that volatility that's happening with the governance and bouncing up and down. But right now, it seems like everything's kind of calming down. And we are starting to move towards this sweet spot. It's starting to make that climb up there. So what I would tell you to do is keep this on a very tight watch list. I'm glad that for the past maybe month and a half, we've seen this little consolidation in this area. We haven't seen these big gaps that we were seeing previously. We were seeing these gaps all over the place every morning. So right now, I'm getting excited to see that. I would wait until this moves into the sweet spot. It'll probably be over this point of maybe 140, maybe that was, and then you could start a long-term position in it. Now, you got to be careful of this. I thought that this may happen, and it turns out that it did. Alibaba did not have enough volume because there's not enough people interested yet to break through this 50-day moving average, which is that yellow line. So the trend is starting to turn down. It hit that 50-day moving average and is starting to move down on you. Eventually, I do think volume will come into this, and you will start to make that push towards that 100-day moving average, 200-day, and you'll be on your way. But this is something where you need volume to drive this thing. People are still not interested totally in this stock yet because of all of the news that's been going on around it. Wait until that happens, but pay close attention to this thing. Put this on a very tight watch list or even buy a tracker share. $129. Worst case scenario, Alibaba goes out of business, never exists again, you lose $129. That's the point of a tracker share, is you see it every single day. So if you're interested in that and these rules and learning all about this, join me. You get the Trading 101 series, which is all of the rules that will make you successful in trading. You get the Employed Trader series, which is 6 stocks that I go through every single day and hold your hand and guide you. And if you're a working person, that is very valuable because I do the legwork for you. You get my exclusive Saturday seminars. One Saturday per month, I do an open Q&A session to the Bidnass Nation only. And you get the chat community of 1,000+ people that all are interested in trading on charts. Come and join us.
You can join Paul and Mo and myself. We'll be trading very soon. Paul's trading $500,000. I started with a meager $10,000, but Mo will be teaching us the day trading aspects, and you can join us live in the Bidnass Nation moving forward. That's our take on Alibaba. We love the stock. We own it, and we'll keep you updated as it moves. See you next video.